Perhaps you're a young person watching this video and you've achieved a few things in your life so far and you want to challenge yourself and move further ahead financially. So you're exploring the idea of potential home ownership and buying a property. That's a very natural thing to want to do as you progress through your years. And I'm here to tell you that there's two main benefits that I see of home ownership. The first being not a financial one. That is having a shelter, so a place to call home. The other is the potential capital appreciation over the long term. There's not a lot of investments that I can think of that you can use and benefit on the daily and have the potential growth in the long term. Take, for example, a car. It's hardly an investment and more like an appliance, so you get my drift. Now, you may have been also reading about these new mortgage rules here in Canada and thinking, the government is trying to keep me away from owning a property and my goal is unsurmountable. And so I'm here to tell you that that's not true. The government's intention of these new mortgage rules is to protect you from yourself, from being in over your head, and also to protect you from potential mortgage rate increases in the future. If you have less than 20% of the purchase price saved in a down payment, that's considered a high ratio mortgage. And all mortgages like that are under these new mortgage rules. So the new mortgage rules apply to anybody with less than 20% saved as a down payment. For people that have over 20% saved, that's considered a conventional mortgage, and this video and those rules don't apply. So if you're in that case, you can move on. For the rest of us who have less than 20% saved, let's talk about that further. So let's say you have the 5% saved as the minimum. The government requires you to use a mortgage insurer, typically Genworth or CMHC, which is a government housing corp, to insure in the event of default. So where you can't continue to pay your mortgage because things are messed up in your life, you lose a job, whatever it is, you lose responsibility financially, so you default. That's to protect the government and the bank in that case. So if you need to have this mortgage insured, meaning a high ratio mortgage, then the premium is added to the balance of the mortgage and you pay it naturally over the 25 years of the amortization of the mortgage through your regular interest and principal payments. As you can probably figure out, the less that you need to insure, the lower the premium. So let's say you have 15% of the purchase price saved in your down payment, then the remaining 5% needs to be insured, and you get the idea. Okay, so let's look at an actual example. Let's say you have the idea of buying a property for $350,000 and you have 5% saved as a down payment. So that means $17,500 is saved as your down payment. The government requires, under these new rules, to have a qualifying rate. So today that rate is 4.64%. Now most people get a 5-year fixed rate mortgage. Now today, that mortgage interest rate is 2.89%. So I've used a mortgage calculator provided by RBC, and I've attached the link of that calculator in the description. So you can play around with that to see the math that I calculated and explore different numbers. Okay, so let's get back to this calculation. So 4.64 is the qualifying rate. So that means the remaining amount that you need to mortgage, in this case, is $344,470 over a 25-year amortization, means you have an interest and principal payment per month of $1,933. But that's the qualifying interest rate. In reality, you're paying $1,610 a month at 2.89% as an example. So what gives? Well, this is a stress test. That's what these new mortgage rules are all about. It's to protect you in the event that things change after your 5-year term. Okay, so in this example, you have a difference in purchasing power of $323 a month. That equates to 17%. So on average, it's about 20% of a purchasing power decrease with these new mortgage rules. Now, I'm not looking at this as a negative. Here's how I would look at it if I were in your shoes. You are buying a property, and let's say at 2.89%, your mortgage payments are $1,610. Great, so you pay that. The bank qualifies you at $1,933. because the bank looks at your monthly commitments to qualify you. That's as simple as it is. So the less monthly commitments you have, the more you can afford, so the more your purchasing power. So let's say it's a 1610 and you're banking $323 a month. Do that. Save it. Use it for something else, but don't spend it. That's my advice. Use this stress test to take advantage of the extra cash flow you have today. Let's say in 5 years, when you renew your mortgage, the interest rate goes up to 4.64% as an example. That means you qualified for it already 5 years ago. You can clearly afford it because you have an extra 323 according to the bank that you can use. So looking at this again, you have the potential to save more money for a rainy day. And if interest rates increase, you have that cushioning already in place. So that's your real estate advice for today. Thanks for joining me, and I'll see you in the future.